Something just broke in the psychology of the silver market. And the crack isn't in the price. It's in the minds of the people holding the metal. After years of suppression, after years of manipulation, after years of being told they're conspiracy theorists, silver holders are approaching a moment that will separate the survivors from the casualties. The moment when they finally win. And winning might be the most dangerous thing that could happen to them. We've spent so much time analyzing vault depletion, industrial demand, and Shanghai premiums. We've calculated supply deficits and mapped delivery notices. We've tracked every COMEX drain and every margin hike. But we haven't prepared for the psychological weapon they're about to deploy against you. The weapon isn't complex. It doesn't require congressional approval or regulatory coordination. It's elegant in its simplicity. They're going to let you win. Then they're going to watch you destroy yourself. The surface event looks straightforward. Silver climbs through $80, then $90, then $100. Your portfolio explodes. Your net worth multiplies. Your phone buzzes with price alerts you've waited years to see. Everyone you know suddenly wants to talk about your silver investment. Your spouse stops rolling their eyes. Your friends stop calling you paranoid. The financial advisors who mocked your allocation start asking for tips. This is the moment you've prepared for. This is vindication. This is victory. This is also the moment you're most vulnerable to losing everything. When you check your phone and see numbers that represent years of salary, something breaks inside your decision-making process. The rational analysis disappears. The lizard brain takes control. And the lizard brain has one command: sell everything immediately and secure the profit. This is evolutionary programming. Your ancient survival instincts are about to become your modern financial destruction. The banks understand this psychology better than you understand yourself. They've studied every squeeze in history. They know exactly how people behave when paper wealth explodes overnight. They know that 90% of silver holders will sell everything between $100 and $150. Not because the fundamentals changed, but because human beings cannot psychologically handle exponential gains. You spent years accumulating silver at $20, $30, $40 per ounce. You calculated the industrial deficit. You understood the supply constraints. You recognized the mathematical inevitability of higher prices. But when those higher prices arrive, when the math proves correct, that's precisely when you will abandon the strategy and sell back to the very institutions you were fighting against. The banks are counting on this. They've positioned their entire defense around this psychological certainty. They don't need to suppress the price forever. They just need to let it rise high enough to trigger mass panic selling from retail holders. Then they scoop up the metal at a discount to what it will ultimately reach when the real shortage hits, when the industrial supply chains actually break, when governments start rationing strategic materials. This doesn't happen by accident. The timing is calculated. They've run the models. They know that when silver hits triple digits, the financial media will suddenly discover the story. CNBC will run silver segments. Bloomberg will interview silver analysts. This isn't validation of your thesis. This is the signal that institutional money needs retail sellers. The psychological manipulation is sophisticated. Headlines will scream about bubble territory. Charts will show exponential curves that look unsustainable. Experts will warn about speculative excess, all designed to trigger your anchor bias. Your brain is programmed to think $30 silver is normal. When you see $100, every cognitive bias screams that this is a bubble about to burst. But here's what your anchored brain cannot process. $50 isn't the ceiling, it's not even the floor. Adjusted for real inflation using consistent methodologies, the 1980 high of $50 equals approximately $600 today. If you sell at $100, you're not taking profits. You're giving up at the moment the real move begins. The banks understand monetary debasement better than anyone. They create the currency. They know its true purchasing power. They know that in a hyperinflationary environment, all nominal prices become meaningless. What matters isn't the dollar price of silver. What matters is the silver price of everything else. Someone knew this moment would test every holder's resolve. Someone prepared for the psychological break that happens when paper gains become life-changing. Someone positioned to benefit from the predictable human response to extreme wealth creation. This move was prepared. While you were stacking ounces, they were studying behavior. While you were calculating deficits, they were mapping psychological triggers. While you were preparing for the price explosion, they were preparing for your reaction to the price explosion. And the reaction is always the same: panic. Euphoria followed immediately by terror. The overwhelming urge to secure gains before they disappear. The banks know that most people who held silver from $20 to $100 will sell everything between $100 and $120. They'll watch the price climb to $200 and kick themselves. They'll watch it hit $300 and feel physically ill, but they won't buy back in, because by then the price will feel too high, too risky, too volatile. This is the wealth transfer mechanism, not the suppression on the way down, the psychological manipulation on the way up. They suppress the price to accumulate your metal cheaply. Then they release the suppression and watch you sell it back to them at prices that feel high to you but are still cheap relative to the ultimate destination. You become the exit liquidity for their accumulation strategy. The banks don't just want you to sell your silver, they want you to sell it for dollars. When you convert silver into cash, you're moving from the hardest asset on earth into the softest liability in the financial system. You're trading scarcity for abundance. You're trading real money for printed promises. In a currency crisis, this exchange becomes mathematically insane. You're swapping the solution for the problem. The dollars you receive from selling silver at 100 will buy less stuff 6 months later than the silver you sold. The gain becomes an illusion. You have more dollars but less purchasing power. This is the tragedy of the hyperinflationary winner. They become millionaires on paper but paupers in reality. The banks understand this dynamic perfectly. They've engineered an environment where winning feels like losing and losing feels like winning, where holding real assets feels risky and holding depreciating currency feels safe. The psychological inversion is complete. Up becomes down. Safe becomes dangerous. Scarcity becomes abundant. And at the center of this inversion sits the individual silver holder, watching their phone display numbers they've never seen before, feeling emotions they're not equipped to handle, facing decisions their brain isn't designed to make. The system depends on this moment of maximum vulnerability, when the gains become too large to ignore and too terrifying to hold, when your net worth swings by more than your annual salary in a single day, when friends start asking for loans, when family members suggest you take profits before it's too late. This is the stress test, not of the silver market, of the silver holder. Most will fail, not because they lack intelligence or commitment, but because they're human beings operating in an environment designed to exploit human psychology. The banks have studied every previous precious metals squeeze. They know the patterns. They know the psychological breaking points. They know exactly how much pressure the average investor can handle before panic takes over. They've calculated that 90% of retail silver holders will capitulate somewhere between $100 and $200 per ounce, long before the real supply shortage creates industrial panic, long before governments implement rationing, long before the price reaches levels that reflect actual scarcity. The mathematics of human behavior are as predictable as the mathematics of supply and demand, perhaps more predictable. This is why the first $100 is just the beginning. It's not the destination. It's the psychological filtration system that separates weak hands from strong hands, emotional holders from strategic holders, people who bought silver from people who understand silver. The real move starts when the retail selling ends, when the last panicked holder has exchanged their metal for promises, when the float has been transferred back to the institutions that need to cover industrial demand. That's when the price discovery begins, when market forces rather than human psychology determine value, when the true shortage becomes visible to everyone instead of just the analysts who could read the data. But by then, the opportunity for ordinary people to participate will have passed. The metal will be held by institutions, governments, and the few individuals who understood that the psychological war was more important than the price war. The system fragments in predictable ways. Paper markets lose connection to physical reality. Industrial buyers stop using futures exchanges and negotiate directly with miners. Retail access becomes restricted through rationing and allocation controls. The silver market becomes a professional market. The public gets priced out not by high prices, but by unavailability. The shortage becomes absolute rather than relative. This transition happens faster than most people expect. The psychological break occurs in weeks. The supply allocation shift occurs in months. The complete transformation from speculation to strategic materials management occurs in less than a year. We're not just watching the end of silver price suppression. We're watching the end of public access to silver markets. The last chapter, where ordinary individuals can participate in price discovery for strategic materials. The banks understand this timeline. They know the window is closing. They know that allowing the price to rise serves their interests by triggering retail distribution before industrial allocation begins. Every ounce sold by a panicked retail holder at $150 is an ounce they won't need to source at $500 when allocation controls are implemented. The consolidation is accelerating. The psychology is breaking. The transfer is beginning. When industrial buyers realize the retail holders are panic selling, they accelerate their own procurement. They know the window for open market purchases is shrinking. They know that waiting means paying higher prices or facing availability constraints. This creates a feedback loop. Retail panic selling convinces industrial buyers to buy more aggressively. Industrial buying pushes prices higher. Higher prices trigger more retail panic selling. The mathematical beauty of this system is that it sorts market participants automatically. Emotional holders get shaken out during the volatility. Strategic holders accumulate during the chaos. Industrial buyers secure supplies before allocation controls begin. And at the center of it all sits the individual holder, staring at their phone, watching numbers climb higher than they ever imagined, feeling simultaneously vindicated and terrified. This is where the real test begins. not of market knowledge or financial analysis, but of human nature itself. The question isn't whether silver will hit $100. The question is whether you'll still be holding it when it does. The mechanics of the psychological trap are sophisticated. The banks know that human beings cannot separate price from value during extreme volatility. Price is what appears on your screen. Value is what the asset represents in the real economy. In a currency collapse, these measurements can diverge by orders of magnitude. Silver at $100 might be expensive in price terms, but cheap in value terms. If the dollar has lost purchasing power through inflation, then $100 silver equals $20 silver in stable currency terms. But your brain sees the nominal price and panics. It cannot comprehend that the bubble is in the currency, not the metal. This is the anchor bias in action. Your psychological reference points are locked to a monetary system that no longer exists. You're using yesterday's measuring stick to evaluate tomorrow's reality. The banks exploit this cognitive lag mercilessly. They know that human psychology adapts slowly to changing circumstances. They know that people will continue making financial decisions based on historical norms, even when those norms have been completely invalidated by current events. This creates a window of opportunity, a period where assets can be mispriced not because of supply and demand fundamentals, but because of psychological fundamentals. Because the market participants haven't adjusted their mental models to the new reality. Someone knew this window would open. Someone positioned to benefit from the mass psychological confusion that occurs when monetary systems break down. The strategy is elegant. Let the price rise high enough to trigger euphoria. Let holders feel vindicated and wealthy. Then watch human nature take over. When people feel wealthy on paper, they want to make that wealth real. They want to convert unrealized gains into lifestyle improvements. This desire is rational in normal circumstances, but these aren't normal circumstances. We're in the middle of a controlled demolition of the global monetary system. In a hyperinflationary environment, holding cash is financial suicide. The traditional safe havens become wealth destruction devices. But this reality takes years to become psychologically acceptable. Even when the evidence is overwhelming, most investors continue operating under the old paradigms. They sell their silver for dollars because that's what they've been conditioned to do. Take profits, secure gains, lock in returns. All of these concepts become inverted when the currency itself is the risk. The banks understand this inversion better than anyone. They created the system that's breaking down. They know its vulnerabilities. They know its psychological dependencies. They know that most people will continue trusting fiat currency long after that trust becomes mathematically irrational. They know that most people will sell real assets to buy fake assets, even as the fake assets lose purchasing power. This creates the perfect exit strategy for institutional holders. Let retail investors bid up the price of real assets. Then let human psychology drive those same investors back into depreciating currency at exactly the wrong time. The wealth transfer happens automatically. No complex manipulation required. No regulatory intervention needed. Just basic human psychology operating in an environment designed to exploit its predictable patterns. The solution isn't about timing the market. It's about changing the denominator. Instead of measuring wealth in dollars, measure it in real assets. Instead of selling silver for cash, trade silver for other forms of real wealth. The gold to silver ratio becomes the critical metric. Currently, it takes 80 ounces of silver to buy 1 ounce of gold. Historically, this ratio has averaged closer to 40 to 1. In monetary crises, it often drops to 15 to 1. When the silver squeeze intensifies, silver will outperform gold. It's a smaller market with more industrial applications. Gold might double while silver increases 5-fold. If you hold 1,000 ounces of silver today, you can exchange them for 12 ounces of gold. If the ratio compresses to 20 to 1, those same 1,000 ounces would buy 50 ounces of gold. You've increased your gold holdings by 400% without adding capital. This strategy solves multiple problems simultaneously. It captures the gains from the silver squeeze without requiring you to sell for depreciating currency. It moves you into a more stable precious metal before the volatility peaks. It positions you for the next phase of the monetary reset. Because after the silver squeeze peaks and crashes, after the retail holders have been shaken out, after the psychological warfare has sorted weak hands from strong hands, gold becomes the center of attention. Central banks hold gold, not silver. Government reserves are measured in gold, not silver. International settlements use gold, not silver. When the monetary system resets, gold will likely be the foundation. By executing the ratio trade, you're positioning yourself ahead of this transition. You're moving from the speculative metal to the monetary metal before the crowd realizes the game has changed. The timing requires patience. You cannot execute this trade based on dollar prices. You must wait for the ratio to compress. You must watch silver outperform gold significantly before making the swap. This might happen at $100 silver. It might happen at $200 silver. It might happen at $300 silver. The dollar price is irrelevant. The ratio is everything. When silver trades at 15 times the price of gold instead of 80 times the price of gold, that's your signal. That's when you execute the trade. That's when you convert explosive gains into stable wealth. This strategy requires psychological discipline. You must overcome your emotional attachment to silver. You must treat it as a vehicle rather than a destination. This emotional detachment is the most difficult aspect. Silver holders develop personal relationships with their stacks. They love the symbolism. They identify with the anti-establishment narrative. Selling feels like betrayal, like abandoning principles for profit. But financial markets don't reward emotional attachments. They reward strategic thinking. They reward optimal decisions even when uncomfortable. The banks rely on emotional decision-making from retail investors. They profit from the psychological inability to sell appreciated assets. The goal isn't to stick it to the banks. The goal is to preserve wealth across a monetary system transition. If that requires trading silver for gold at optimal ratios, then that's what strategic thinking demands. If that requires ignoring your emotional attachment to specific metals, then that's what wealth preservation requires. The system is designed to exploit emotional decision-making. The only defense is analytical decision-making. The only protection is mathematical thinking. Numbers don't lie. Ratios don't manipulate. Mathematics doesn't have emotional attachments or political agendas. When the gold to silver ratio compresses to historical lows, it's telling you something important about relative values. When it expands to historical highs, it's providing different information about optimal positioning. Ignoring this information because of emotional attachment to silver is exactly the kind of mistake the system is designed to encourage, exactly the kind of psychological error that transfers wealth from retail holders to institutional players. The escape route exists. The mathematical pathway to wealth preservation is clear. The strategic framework for navigating monetary chaos is available. But it requires abandoning the psychological comfort of simple narratives. It requires embracing the complexity of dynamic asset allocation. It requires making decisions that feel wrong in order to achieve outcomes that are right. Most people cannot make this transition. Most people cannot separate strategy from emotion. Most people cannot treat their investments as financial instruments rather than personal crusades. This is why wealth transfers occur. This is why crises redistribute capital from the many to the few. This is why psychological warfare is more effective than price manipulation. The banks don't need to suppress prices forever. They just need to exploit human psychology at critical moments. They just need to let people destroy their own wealth through predictable emotional responses to unpredictable circumstances. The silver squeeze will test every holder's ability to think strategically under pressure, to make optimal decisions when emotions are screaming for suboptimal choices, to preserve wealth when preservation requires counterintuitive actions. The mathematics are clear. The historical patterns are documented. The strategic pathways are mapped. But knowing the theory and executing the practice are completely different challenges. One requires understanding markets. The other requires understanding yourself. The psychological pressure will be unlike anything most people have experienced. Your net worth will swing by multiples of your annual income in single sessions. Friends will offer unsolicited advice. Family members will suggest taking profits. The financial media will run stories about silver bubbles. Experts will warn about historical crashes. Charts will show exponential moves that look unsustainable. Every external voice will reinforce the pressure to sell. Every internal fear will amplify the message to secure gains before they disappear. This is the designed outcome. The system depends on this psychological pressure. It profits from the inability of most people to separate short-term volatility from long-term value preservation. The escape route requires rejecting this psychological manipulation. It requires treating market movements as information rather than instructions. It requires making decisions based on mathematical relationships rather than emotional responses. When the gold to silver ratio compresses to historical lows, that's mathematical information about relative values. When it expands to historical highs, that's different information about optimal positioning. The ratio doesn't have emotions or political agendas. It doesn't manipulate or deceive. It simply reflects the mathematical relationship between two monetary metals across different market conditions. Following this mathematical guidance instead of psychological impulses is how wealth gets preserved during monetary system transitions. It's how strategic holders distinguish themselves from emotional traders. It's how the few benefit from crises that destroy the many. The question isn't whether you know what to do when silver hits $100. The question is whether you'll actually do it when every instinct screams for you to do something else.